Usually when we talk about a medical diagnosis, you expect precision, right? Like you break your arm, the x-ray shows that jagged white line, and the doctor just points and says, yep, there it is, broken.
Right. We love that kind of binary clarity. It's comforting.
Exactly. We love the clarity. But when you step into the world of corporate finance and stock valuations, especially around emerging technologies, that x-ray machine just completely shatters.
It really does. You're looking at a diagnostic landscape that is, well, entirely murky.
And when you look at a defense contractor like BigBear.ai, a company trading for roughly $3 a share that just sort of bolted a generative AI rocket onto its slowing legacy business, the waters get even muddier.
Oh, absolutely.
So today, we are opening the hood on an August 2026 equity research report for BigBear, trading under the ticker BBAI. We really want to figure out what it actually costs the company to acquire growth.
Yeah, we're going to deconstruct the reality of their cash burn. We need to figure out if, slapping an AI label onto a business actually justifies a premium price tag.
Right, because whether you're actively investing or just trying to understand the actual business mechanics behind this whole AI boom, this deep dive is going to give you the tools to spot the difference between like top-line mirages and bottom-line realities.
And we should probably start with the mirage, right?
We definitely should.
Yeah.
Because on the surface, reading the headlines from their Q2 2026 earnings, things look fantastic.
They do. They look really strong.
I mean, Q2 revenue came in at $36.7 million, which is up 13% year over year.
Yeah.
And even better, their gross margins expanded massively, jumping 781 basis points up to 32.8%.
Which is a huge jump.
Right.
But the research report notes this is largely driven by their recent acquisition of a generative AI platform called Ask Sage.
Right.
And Ask Sage carries those much higher sort of software-like margins.
And here's where you have to pull the lens back. If you look at the trailing 12-month basis, the TTM revenue is actually down 13.72%.
Yeah, that's the kicker.
And the TTM gross margin is sitting at just 27.9%. So that divergence kind of tells me the core engine of this company was actually stalling out before they went and bought Ask Sage to, well, artificially inflate the quarter.
It's a classic move. That trailing 12-month view exposes the structural reality of their core industry. Because government contracting, which is what they do, is not this smooth, predictable software-as-a-service subscription model.
No, not at all.
It operates on this incredibly arduous procurement cycle. I mean, you spend millions responding to requests for proposals, navigating security clearance.
Waiting on federal budget cycles to clear.
Exactly. And when you win a massive contract, sure, revenue spikes. But when a contract ends or it gets delayed by a continuing resolution in Congress, revenue just craters.
Right.
So BigBear's legacy work, that lower margin consulting and data integration stuff, is still the heavy anchor on their financial profile.
Okay, let's unpack this. Because bragging about this Q2 revenue bump, it's a bit like boasting about a huge raise at your weekend side hustle while hoping no one notices your salary got slashed at your main 9-to-5.
That is a perfect way to look at it.
They essentially brought a shiny new engine to hide the fact that the chassis is rusting. Buying Ask Sage brought them a temporary revenue bump and some margin padding, but separating organic growth from acquired growth is just critical here.
It is, because purchasing a high-growth asset doesn't magically fix the underlying inefficiencies of the parent company. As an analyst, you always have to strip out the acquisition revenue to see if the legacy business is actually winning new clients.
And that negative 13% trailing figure.
Right. It suggests they are actively losing ground in their traditional defense markets, which makes the Ask Sage acquisition less of a strategic expansion and more of, like, a life raft.
Okay, so if the top-line growth is a bit as an M&A life raft, we have to look at what that life raft is actually costing them on the bottom line.
And the optics here are notoriously tricky.
Yeah, because looking at their net loss, it appears like they made this miraculous recovery. I mean, they went from a bleeding $228.6 million net loss in Q2 of last year down to just a $25.7 million loss this quarter.
Which looks incredible on paper.
Right. The untrained eye sees that and assumes, oh, they slashed costs and are marching toward profitability.
But the report clarifies that this improvement is a massive accounting illusion.
An illusion.
Completely. It's driven by non-cash items. Specifically, there's a $135 million decrease in derivative fair value losses and a $70 million decrease in goodwill impairment.
Okay, wait, let's translate that goodwill impairment for a second, because when Big Bear buys another company, they often pay a premium over the raw value of that company's assets, right? Like the patents, the desks, the servers. And that premium just sits on the balance sheet as goodwill. But if the acquired business underperforms its projections, accounting rules basically force the parent company to admit they overpaid and they have to write down that value.
Exactly. It forces transparency. The company takes a massive net loss on paper for the quarter they record the impairment, but no actual cash leaves the bank account that day.
Oh, wow. Oh,
Yeah.
wow.
So last year, Big Bear was forced to take a massive write-down on previous acquisitions. This year, they didn't have to record one. So the year-over-year comparison looks like a $200 million improvement.
But fundamentally, the daily operations haven't improved at all.
Not at all. It is entirely a ghost in the accounting machine.
So to see the actual operational health, we need to look at adjusted EBITDA earnings before all those non-cash accounting items. And that metric actually worsened, didn't it?
It did. The adjusted EBITDA loss widened to $11.6 million.
Why? Where's the money going?
The drain is coming from their selling, general, and administrative expenses, SG&A. It surged by $10.4 million up to $31.8 million.
You're stalling over it.
Basically. The report points to legal fees, proxy expenses, expanded marketing, and the amortization of the Ask Sage acquisition itself.
So buying your way out of a growth problem carries this hidden compounding cost.
Absolutely. You pay the upfront purchase price, sure, but then you inherit all the back-end integration costs. You have to hire lawyers to merge the entities, spin up new marketing divisions to cross-sell the new software, and you just absorb the acquired company's existing overhead.
Man. So their operating cash burn is accelerating because maintaining this newly acquired growth is inherently more expensive than just generating it organically.
Exactly.
And that accelerating cash burn brings us to, honestly, a massive contradiction in their capital structure. Because here's where it gets really interesting.
The balance sheet.
Yes. The balance sheet shows a very comfortable cash cushion. As of June 30th, 2026, they had $409.8 million in total cash and investments.
Which is a significant runway for a company of this size.
Right. But then, yet, just 1 month later, on July 31st, they filed a $100 million at-the-market equity offering, or ATM.
Yeah. That's
Like, for context for you listening, an ATM offering allows a company to slowly trickle new shares of stock into the open market. It raises cash, but it dilutes the ownership stake of every single existing shareholder.
right. If you own 1% of the company and they flood the market with new shares, you suddenly own 0.8% of the company. Your voting power, your claim on future earnings, it's permanently reduced.
So why do it? It's like having $400,000 sitting comfortably in your savings account, but deciding to sell off a percentage of your house to raise another $100,000.
Yeah.
Why would they dilute their own shareholders if they're already flush with cash?
Well, the timing of that ATM filing is a glaring red flag. If we connect this to the bigger picture, it usually signals one of two things. My read is that management's internal modeling looks much worse than the public numbers.
Meaning?
They foresee that surging SG&A expense completely eating through their cash reserves faster than anticipated. They might be forced to secure more capital just to keep the lights on over the next 24 months.
And the other option?
The alternative scenario is they're building a war chest. Management might look at the competitive landscape and realize, hey, the core business cannot be salvaged organically, so their only survival mechanism is to become a serial acquirer.
Wow. So they need that extra $100 million just to buy the next Ask Sage and the next one after that, purely to maintain the narrative that they're a growing AI company.
Right. And they avoid taking out traditional debt because debt requires mandatory interest payments, which would drain their cash even faster.
Oh, that makes sense. An ATM offering has no interest payments.
Exactly. The cost is just quietly absorbed by the shareholders whose equity is diluted. I mean, the share count has already nearly doubled in recent periods. They are funding their survival by cannibalizing their own investor base.
Okay, so if the moat is that thin, the organic growth is negative, and massive dilution is looming, You would logically expect the broader market to punish this stock, right? Pricing it at a severe discount to reflect all that distress.
You would think so.
But the valuation completely ignores those fundamental realities. Big Bear trades at an 11.77 price-to-sales ratio on a trailing 12-month basis.
And just for context, the average for the broader IT industry is just 1.8.
Right. And looking forward, their forward price-to-sales is 8.66. Now, compare that to Palantir, the undisputed giant in the defense data space. They traded at a 33 forward multiple. But Palantir has an incredibly sticky software ecosystem.
Yeah, it's deeply embedded across the Department of Defense. Once a government agency integrates Palantir, ripping it out is practically impossible. That is a massive competitive moat.
But Big Bear does not have that luxury. The research report explicitly describes Big Bear's competitive moat as thin. I mean, they're fighting giants like Palantir, Booz Allen, Lockheed for scraps in a highly fragmented, brutal procurement environment.
And if you look at another competitor like Parsons, who handles traditional defense engineering and IT, they trade at a forward multiple of less than 1. Meanwhile, Big Bear has a trailing 12-month net margin of negative 65.2%.
Meaning they're losing money on every dollar they bring in.
Exactly.
So what does this all mean? They have the margin profile of distressed legacy contractor, but they're priced like a premium Silicon Valley tech darling. Are investors just blindly paying an AI tax on the ticker symbol?
That's precisely what it is. The AI tax is this psychological premium driven by the sheer terror of missing out. The market is watching companies like NVIDIA reshape global infrastructure, and investors are just willing to blindly assign software multiples to anything with artificial intelligence in its pitch deck.
Even if the numbers don't back it up.
Right. But if you try to analyze the market's underlying logic here, investors are attempting to price in a business model transition.
Okay.
They are betting that Big Bear can successfully evolve from a low-margin sort of body shop consulting firm into a high-margin, scalable software-as-a-service company via Ask Sage.
Because with a true SaaS product, once the software is built, the marginal cost of selling the next copy is virtually zero.
Precisely. If Ask Sage becomes a dominant platform, the margins expand exponentially. But the fatal flaw in that thesis, which the report heavily emphasizes, is that this transition is completely unproven.
Right.
Converting a backlog of bureaucratic government consulting hours into a streamlined, high-margin software revenue stream, that is a monumental operational challenge. And the market is pricing Big Bear for flawless execution in an environment where their historical execution has been riddled with cash burn and dilution.
And the people actually putting money on the line seem to be waking up to that execution risk because the technical charts are just a bloodbath.
Oh.
As of August 12, 2026, the stock closed at $3.33. That is down 64.5% from its 52-week high of $9.39 and down 38.3% year-to-date. The stock takes the stairs on the way up and the elevator on the way down.
And that volatility is systemic. The report highlights a beta of 3.26.
Which means what exactly for the average investor?
Well, beta measures a stock's sensitivity to broader market movements. A beta of 1 means it perfectly mirrors the S&P 500. So a beta of 3.26 means that if the broader market experiences a minor, say, 2% pullback, Big Bear could violently gap down by 6 or 7%.
Wow.
It aggressively amplifies market pain, which makes it a really toxic asset to hold during any macroeconomic uncertainty or a sector rotation away from tech.
And Wall Street sentiment is aligning with that chart destruction. It is overwhelmingly net bearish. Analysts at Cantor Fitzgerald downgraded their price target to $4 and other coverage ranges as low as $2.75.
The consensus basically boils down to evident execution challenges.
But amid all this institutional pessimism, the report flags two silver linings. First, their backlog grew 9% in Q2, providing some visibility into future cash flows. And second, and this is much more curious to me, there has been net insider buying of 190,081 shares over the trailing 90 days.
Now, insider buying is classically viewed as a constructively positive signal. The old adage is that executives might sell stock for a dozen reasons: buying a house, taxes, paying for college, but they only buy stock with their own cash for one reason.
Yeah.
They believe the price is going to go up.
I would normally agree. But wait, let's run the math on this specific signal. If the ship is sinking, SG&A is soaring, the charts look like a double black diamond ski slope. Why on earth are insiders buying?
Well, you have to look at the scale.
Right, they bought roughly 190,000 shares. At an average price of around $3, we're looking at perhaps $570,000 worth of stock. Big Bear has a market cap of $1.5 billion.
Right.
In the context of a billion-dollar enterprise, a $500,000 insider purchase is less than a drop in the bucket. Is this a genuine signal of faith or just cheap window dressing?
It is optically useful, but fundamentally immaterial. It feels like a carefully orchestrated PR move.
That's exactly what I was thinking.
Management knows the charts are broken and the overhead is soaring, so a few executives pull $500,000 to trigger automated insider buying alerts for retail traders.
It creates a narrative of confidence without requiring serious capital commitment.
Exactly. And the report explicitly warns against speculative traders trying to build a short squeeze thesis around these purchases. It calls it unconfirmed and highly speculative.
Because a true conviction play would involve millions of dollars, right? And a cessation of the ATM equity dilution.
Precisely. You don't buy $500,000 of stock in your personal account while simultaneously preparing to dilute the corporate float by $100 million if you actually believe the equity is deeply undervalued.
Yeah, that contradiction is glaring. So the bearish sentiment, the broken technicals, the stretched valuation, the contradictory capital raises crowd, it all paints a pretty bleak reality. So we have to pivot to the future.
What comes next?
Right. The research report assigns Big Bear an overall rating of 4 out of 10, cautiously neutral with a bearish tilt. But it does chart a specific, albeit incredibly narrow path to recovery. What specific catalyst would it take to actually prove the bears wrong and turn this ship around?
Your recovery hinges on two operational imperatives. First, Ask Sage must achieve commercial expansion outside of the federal government.
Because the defense sector is just too slow.
Too slow and too fragmented to support their current valuation. If they can prove that private enterprises, banks, healthcare networks, logistics firms are adopting this AI platform, the total addressable market explodes, and that margin profile shifts permanently.
Okay, that's step one. What's step two?
Second, they absolutely must stabilize the SG&A expense. The bleeding from legal, proxy, and marketing fees has to flatline to prove they can operate an acquired asset efficiently.
They have to prove they are an actual operating company, not just an acquisition shell.
Exactly. And the timeline for this reckoning is immediate. The report points to the Q3 2026 earnings in late October or early November as the critical catalyst.
Right, because management publicly set a target of 17% overall revenue growth.
Yep. If they miss that benchmark after spending millions on Ask Sage, the market penalty will be severe.
That will be brutal.
Furthermore, management has actively teased the possibility of more accretive M&A in the second half of 2026. If they manage to announce a highly strategic, smartly priced acquisition that adds immediate free cash flow without requiring massive shareholder dilution, that could serve as a material catalyst to reverse the downtrend.
But the research report introduces a fascinating hurdle it calls the conditions of honesty.
Yes, I love that phrasing.
Yeah, it's so good. To actually re-rate this stock from a high-risk gamble into a credible growth story, the company must demonstrate organic growth of more than 10% year over year.
Meaning, stripping out all the revenue they bought with Ask Sage and proving that the foundational legacy business is actually winning new contracts.
They essentially have to thread a needle in a hurricane here. Grow organically, stop burning cash on legal and marketing, and somehow avoid crushing their own stock price with that $100 million ATM offering.
That condition of honesty is the crucible. Because look, the market currently forgives a lot of operational sins in the artificial intelligence sector, provided a company can deliver explosive top-line growth.
Sure.
We saw it with Amazon in the early days, and we see it with AI infrastructure plays today. If revenue is compounding organically at 50 or 60%, Wall Street will completely ignore cash burn and dilution.
Growth serves as a blanket that covers every other flaw on the balance sheet.
Exactly. But Big Bear simply does not have that blanket. Declining 13% organically while trading at an 11x multiple is an unsustainable divergence.
Right.
They're wearing the valuation multiples of a hyper-growth tech darling while generating the operational metrics of a distressed legacy body shop. Bridging that gap requires execution that they simply haven't demonstrated over the last 12 months.
So, bringing this all together for you listening, the core takeaway from this deep dive is really a masterclass in looking past the corporate buzzwords.
Definitely.
Simply having AI in your company name or acquiring a generative AI platform to juice your quarterly revenue print does not magically translate into long-term wealth creation for your shareholders.
The mechanics of the underlying business always reassert themselves. You have to isolate organic growth from acquired growth. You must look at the actual cash leaving the door through SG&A rather than just the adjusted accounting metrics.
And most importantly, you have to monitor shareholder dilution. Raising capital through an at-the-market offering is a silent tax on your ownership stake.
As we've seen today, the financial x-ray of an emerging tech company can be incredibly misleading if you don't know how to differentiate between paper write-downs and actual cash flow.
The AI tax is a very real phenomenon, and the market is currently punishing investors who pay it blindly without demanding operational excellence in return.
It's a harsh lesson.
Which leaves us with one final lingering question to ponder as we wrap up this analysis. Considering everything we've unpacked, the reliance on acquisitions to mask organic decline, the massive cash reserves sitting comfortably alongside aggressive shareholder dilution, and those towering overhead costs eating away at their margins.
Right.
If a company's primary strategy for growth is buying other AI platforms, while simultaneously diluting its own shareholders' equity just to pay for the overhead to run it all, are they actually building a unified, scalable tech powerhouse? Or are they just running a highly inefficient, incredibly expensive hedge fund disguised as an AI company?
That is the ultimate question.
Something to mull over. Keep digging, keep questioning, and we'll catch you on the next deep dive.